Hey everybody, it's Big Cheds from Twitter, Cheds Trading from YouTube. This is going to be another daily education video. You can also check me out on Bitcoin Live. Today we're going to look at moving average basics. This is lesson 41 from the Trading Wisdom book. Let's jump right in. So a moving average is an average of price over time, and there's two types of moving averages, two major types, exponential and simple. A simple moving average, for example, an SMA 10, means that each of the last 10 candles are equally weighted when that price is calculated. For example, I have the 200, which is the trend in classical charting. We talked about that in yesterday's video. So each of these last 200s are equally weighted. The other main type is an exponential moving average. It adds weight to the most recent period and decreasing after that. Essentially, the price is more sensitive to the moving average, or the moving average is more sensitive to the price. You get more price interactions with that. So with my system, I have the EMA 8. That means the most recent candle has more price weighting than 8 candles ago. Exponential moves versus simple. Generally, you're going to use an exponential moving average for a short-term moving average, like an 8 or even a 12 and a 26 are very common. And then you would use those for a crossing, the 12 crossing the 26. Or for example, in my system, the 8 potentially crossing the 34. Now here we have a good example of a muted cross because the price is sideways. Moving average crosses work best in trending markets, not sideways markets. So for example, you would have wanted to see the moving average cross here for a stronger signal on that first test. But what happened is both of the moving averages are moving sideways, so you have a muted cross. If there was 12 or 26, 5 versus 10, simple, it doesn't matter. The longer term moving average, you want to have a sharper cross rather than a sideways cross, right? You're wanting some type of a signal. You want it to have more context. Secondly, you want to look at price distance to the MA2, to the moving average when it's crossing. So for example, people talk a lot about a death cross and a golden cross. Death cross 50 crossing the 200. Again, with Bitcoin, we see the price had already dropped quite a bit when that moving average cross took place. So with a moving average cross, you want to have the price close to the cross so that the good part of the move is not already baked in. Similarly, the golden cross here in Bitcoin, look where the price is. Look, when the cross is happening, you already have a good part of the move baked in. So when you're using moving averages, make sure you have a trending market. Make sure you understand exponential versus simple. And take a look at the price distance to the moving average cross. This is part of the daily education series on my YouTube. Of course, I'm on Twitter at Big Cheds. Check me out on Bitcoin Live. Folks, thank you so much for being here today, and I will talk to you soon. Big Cheds out.